Major support for these programs is provided by Bank of America, Merrill Lynch, and Perfect Building Maintenance, New York Community Bank, All Nation Renovation, Kilroy Architectural Windows, New York's Window Company, Greenberg Traurig, LLP, M&T Bank. Additional support is provided by AVR Realty Company, LLC, Ackman Ziff Real Estate Group, LLC, Bingham McCutcheon, LLP, Briarwood Organization, Capital One Bank, C.B. Richard Ellis, James Orphanides, Centurion Holdings, Cushman and Wakefield, Dimes Savings Bank of Williamsburg, Douglaston Development, DDG Partners, Eastern Consolidated, Hal Fettner, Durst Fettner Residential, Friedman, LLP, Accountants and Advisors, Gemini Real Estate Advisors, LLC, Genova, Burns and Gian Tomasi, Grubb and Ellis, Investors Savings Bank, Jack Jaffa and Associates Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, Madison Realty Capital, Massey Knackle Realty Services, Meridian Capital Group, Margolin Weiner and Evans, LLP, Certified Public Accountants and Business Advisors, Newmark Knight Frank, RAL Development Services, The Spandrel Group, LLC, Siami Development, SJP Properties, Site Comply, Sterling and Sterling, Stephen Napolitano, The Wickoff Group, Urban American.
So certain people have said that the market has really improved in New York. As I stated a couple weeks ago on my show, I started the show saying, happy days are here again. I don't know. I'm not sure, but I've brought together today individuals who are involved with the acquisition and development of properties in the metropolitan area and even around the country to provide their insight on the state of the market. My guests today include Rob Silpe, Senior Vice President at Boston Properties, Jack Connolly, Managing Director, UBS Realty Investors, Adam Popper, Senior Vice President and Head of U.S. Acquisitions at Vornado Realty Trust. And last but not least, the guy who helped me put this group together, my executive producer of the broadcast, Jeff Lenoble, chairman of the real estate practice and a member of the executive committee at the law firm of Schulte, Roth, and Zabel. So, counselor to the people, what do you see happening? Are we in irrational exuberance? What's the market?
It's been a great 6 or 7 months, Michael. The activity level has dramatically increased since 2009. There's been lots of money available. The flow of deals has increased. Acquisitions of all property types have increased. And we're seeing this especially in areas like New York, Washington, Boston.
But you know what? You bring out something interesting. And some people who recently came back from the ICSC or the ULI said the following to me. There are two markets in the world today that have really improved. New York and Washington. What do you see? I mean, you're in New York, Washington. These are your markets.
We spend a lot of time. Obviously, Vornado is beachheads are in both Washington and New York City, and there is absolutely a tremendous amount of investor exuberance in those markets.
And what about the rest of the country?
I think Boston is lagging behind those two markets. San Francisco's obviously been very busy. The Valley's gotten very hot, so I think that investors are back out in San Francisco. And LA is still lagging, right? So those 5 gateway markets are busy, but I think that New York and DC.
And what about the Chicago market? I mean, are people?
I didn't know that there was a Chicago market.
But you know what? It brings up an interesting point. Boston Properties, I'm fortunate to have two of the finest REITs in the country, having Boston and Vornado here. Boston is in Boston. You're in Washington. What about my friends across the river? The state of New Jersey. How do you look at that? I mean, you've owned the property out there in Princeton. Jack, you've owned the property out there. I mean, it's a different market, the state of New Jersey.
Well, for the most part, I mean, we've stayed very close to a strategy that our chairman and established for the company a long time ago, which was to be in the best supply-constrained markets and be in the best buildings in those markets. And we don't really stray very far from that strategy. We try to stay to what we know. And I think the strategy has proven itself. In up markets, I think we would tend to outperform to the upside. And in down markets, I think we've also proven that the strategy outperforms as well.
Now, there's and I'm bringing up New Jersey because there have been a number of recent developments besides the property sales that both of you are involved with. I mean, the biggest item that really came up is this, the Panasonic moving 7.5 miles from Secaucus to Newark. And Newark, is the largest city in the state of New Jersey, but I don't see Vornado, Boston Properties, or UBS saying, I want to be in Newark. Now, Panasonic is a great tenant, but Panasonic is really going in there for $130 million in tax credits, if you really look at it that way. What's your thoughts about non-space constrained markets? Like Newark is not, I don't think it's something in your ballywhack, right?
No, I don't think that. I mean, Newark has a tremendous amount of land where you could develop buildings. There's not a tremendous amount of corporate growth in the city of Newark. It's still a market that is struggling to kind of find its anchor. And it might be great for Panasonic. It's a New Jersey-based company that's been there for decades.
25 years.
Right. So I think that that's an important tenant for that marketplace. But I don't see a lot of New York City-based tenants going to Newark as a low-cost alternative. It just doesn't seem to make sense. There are other New Jersey markets, there are other suburban markets for them to go, and we're still on the.
But you know what? This relates to New York City. I did a show a couple weeks ago, and when I joked with the Happy Days Are Here Again with the 4 office brokers, and I said to them, "What do you think about Forest Hills, New York?" Because it was Josh Musk was on the show before, and the guy from Jones Lang LaSalle, one of the agents, said, "You know what? Why do I have to go to Forest Hills? I could be in Lower Manhattan for that type of rent." I mean, what do you think of the boroughs, and what do you see? Would UBS make a decision to go into the boroughs?
For multifamily investments, we are in the boroughs. We have 2 investments in Williamsburg.
Rentals?
Rental properties that we have worked on in Williamsburg. And I think the state of multifamily rentals in New York is so tight that we would look at almost any borough for housing.
I mean,
office.
Your business in this market is office,
Yes.
but in certain other markets, your business is residential.
Well, we've started, as I said earlier, to dabble in residential, but almost always as part of a larger mixed-use project.
Adam? And then
Well, in the suburbs, we have substantial retail holdings. I mean, a major component of
you're
our
a
company.
major retailer.
Right. I mean, we're a major retailer. So we have significant holdings in the boroughs, in Bronx and Queens, and so I think that you'll continue to see us looking at those markets from that perspective, not from an office perspective.
what are you seeing with your clients?
Well, you talked about, we had a show recently, I did a seminar with the real estate brokers, the sales brokers in New York, and someone asked them, if you had your own money to invest, where would you be investing? And their response was almost unanimously the same. Williamsburg in Brooklyn, possibly Dumbo, but certainly downtown Manhattan as the hottest market right now, maybe in the United States. And I think we're seeing a lot of activity from our clients in Lower Manhattan, buying existing buildings, buying partial sales interests in buildings, developing new construction, which is proliferating in downtown Manhattan. So I really think downtown Manhattan is a boom right now.
What about you? Do you think downtown Manhattan, and this relates to downtown Manhattan and the 5 boroughs, New York City is under-retailed. Urban retailing in New York City does great. And I mean, Vornado is a great example of it. They have this Queens, the second Vornado property in Queens where they put Kohl's, Century 21,
Right, Rego Park.
Rego Park, which is a great location. And any of the Vornado retailing within the 5 boroughs is doing great. Do you see, would you see Vornado go into a retail downtown Manhattan?
Well, certainly the tourist traffic justifies it. It's just, what drives the retailers is the ability to kind of aggregate really good quality blocks of space. And the buildings downtown really kind of limit you to what you can aggregate. So I think that if the opportunity presents itself, you'll see us downtown on the retail front.
What about you? Do you like retail?
We are very active retail buyers and all that. It's very difficult in an urban setting to buy retail. Our investments are fundamentally core, and our diversification is broad-based. And as investors look at the various segments, when you add to that at the margin a retail property that has a $1,600 per square foot value and a 4 cap to a portfolio that probably has an average value of $250 and a 6 cap, it sticks out. It may be tremendously viable, but that ends up being the tail wagging the dog, and you explain too much of
It's
that.
interesting, and I'd like everyone's opinion on this. I did a show recently on retail, and I had Mike Papagallo, who is the EVP and COO of Kimco. And he said they have owned land in Harlem on 125th Street, and Harlem has done rather well in West Harlem, not East Harlem, and they are probably going to do a development in West Harlem. Now, I know that Vornado owns a site on 125th Street and Park Avenue, which is a great site. It could be used for a variety of things. Do you think anything is going to happen with Harlem?
Well, certainly Harlem's a dynamic market, and I think that you'll see, us not kicking off the site, but going back to the plans and looking at it and trying to figure out how to value that site and maximize its
That
potential.
site was originally going to be a hotel site.
Right.
It was
But
originally.
I mean, I think that there are other uses now that, Harlem has really kind of matured and become a little bit more sophisticated. And I think it's become a more accepted marketplace. And I think that investors are there, the demand is there, the traffic is there. So, I mean, I'm not sure what the end use is, but I know that we're spending some time looking at it.
What about land prices today? We were talking up before, on development. I mean, construction costs haven't really dropped down. They dropped a little bit, but there's a big question of the labor costs, and because anyone sitting over here has to do a union construction job, which is expensive. Do you think the prices of land that have recently been traded or going are a little high? I mean, I'm Dr. Doom and Gloom, so
Well, I mean, land prices tend to be sticky. They go up very quickly, and then unless it's a distressed situation, they really don't come down.
Right. They don't trade when the market's soft. No,
they don't trade.
Liquidity has so much to do with land prices also.
Let's talk about liquidity. I mean, I got 2 REITs who've been able to raise money at prices which are unbelievable. I mean, REITs have raised this year, $23 billion. I mean, over $200 billion over the last couple of years. So you have a capital ability because of the public markets and so on. Are you getting money from the CMBS market? Are you getting money from the national banks? Where are you getting financing?
Well, we've, like the other REITs, have done a lot of capital raising in the last couple of years, and it's been a combination of capital. We've done, corporate unsecured debt. We've done some property level financings, mostly in the last year, really with life companies, long-term fixed rate debt. And we've also issued equity several times in the last year and a half. So the capital markets have been, very favorable. The borrowing rates are very low, and the ability for a company like Boston Properties to access the capital markets, I think, really has created a strategic advantage for us in
Jack?
many ways.
Our funds are fundamentally very low leveraged, and one of our competitive advantages is that we are capable of buying all cash. And our use of leverage is focused on finding those opportunities where there are existing debt that may be maturing in 2 or 3 years. And rather than take on the refinance risk, we'll just pay it off. And so we can walk into situations that have near-term maturities or debt that needs to be right-sized and add the equity. So we focus on using our equity to its maximum ability.
Yeah, we were talking prior to the show about some of your acquisitions, and your acquisitions recently have been done because they've been, as our counselor would say, they were a little structured problems, right? Let's talk about how people have been buying because the deals that you've been buying didn't make sense before, and now they've been recapitalized or restructured into a different way.
Well, I mean, I think that the deal that we recently closed probably made sense to the people when they bought it because they were buying on the forecasting of rents continuing to go up.
That's the point. You know,
right?
everybody was projecting numbers which were unrealistic at that time.
But I think that, the transaction you're speaking of on Park Avenue, One Park Avenue is really a transaction that evolved from the sponsor and the equity really kind of being fractured and us coming in with speed and surety of execution and trying to, put all the pieces back together and get everyone, what they needed quickly, and then kind of reposition the asset and bring it back to its prominence. So I think that all the people here, their companies could do the same transaction. Just a question is we just happen to be in the right place at the right time.
Now, you've done similar situations this year, haven't
Yes,
you?
and the toughest lesson I've had to learn over the last couple of years is just because it's complicated and convoluted and fractured doesn't necessarily mean that it's opportunistic or it will make any money.
Right.
And so a big part of what we do and what I try to do is sift through what is just broken and versus what can be fixed. And so, and take advantage of the strengths that you do have. Adam's absolutely right. It's much of the opportunistic or buying that you see is being in the right place at the right time.
Right. And it's value added. You guys can add a lot of value to a deal as well. I mean, I've had the good fortune of working with all of them on acquisitions at one time or another. And the good real estate professional knows how to analyze and knows how to find the crevice in the capital stack, knows when to attack a deal and how to execute it.
What's that?
Sorry.
Sorry. No.
I was going to say that, even though, it could be value added, I mean, the entry point is always important. And finding a good entry point in today's market is as difficult probably as it's ever been.
Right, you still have to be discerning, right? I mean, you can't just buy because everyone's buying. You have to still stick to your fundamental discipline of knowing where you fundamentally believe the market is, not where you're being told it's going.
That's why the three of you are on the show.
Right.
I suppose there are people who are buying based on dreams today again. I believe that this year certain people are buying on long-term expectations. Like you even said, when One Park Avenue was acquired at over $600 a foot, they thought they'd get $90 a square foot because the market was going up. Aren't people, not you people, but aren't there certain buyers out there that you've been seeing?
There are auctions going on now for distressed properties.
That's exactly what I'm saying.
Just like there were auctions going on in 2006, 2005, where people are just outbidding each other, and their bidding process is so reminiscent of what it was 4 years ago that it's really scary. And you mentioned one other thing. People underwrote deals based on projected rents years ago. I think people are now projecting rents. They may not be underwriting the deals based on the projected rents that are going to take place in the years to come, but they're certainly very optimistic and thinking about the increase in rents of years to come.
Rents are a tale of two cities also. Class A office rents are one, and Class B has really not improved. They've gone up, but tenants still want to negotiate on a Class B property. I mean, you don't have to worry about it. You don't see that because you don't have Class B properties.
Well, the trends in our portfolio, or at least what we've been seeing in the last 6 or 12 months, are very positive. Rents are trending up. Concessions are trending down.
But you're in the Class A plus buildings.
You're in a certain type of building. I mean, you're not in a building which is a building between 6th and 7th, 6th and 8th Avenue in the former garment center or in something in Midtown South in an area where somebody could find space somewhere else. I mean, you don't have anything in Hudson Square or that type of market in a 70-year-old building that, you know, isn't prepared. I mean, you know, it's certain people like loft space, but you don't go into that.
No, but you know, I think the quality of our buildings and the quality of our sponsorship is really important, and I think it's in times like this, rents are down in our buildings versus the peak back in 07, 08. But I think a lot of tenants have taken this as an opportunity to trade up, so to speak.
I mean, Class A rents are still down 24%.
I'm not
Right,
disagreeing,
so-
but I will.
It just feels better. It's just not as bad as it
But
was.
it's interesting, Adam. The interesting story. There's an analysis, and I did a 1010 Wins report on this, saying that in the first quarter of 2011, there were 12 transactions for rents greater than $100 a square foot. A number of them happened to be in your properties, and the highest was in your property at 767 in the GM building.
Sure.
The number in 2008 was 91 rents greater than $100. So, the market has improved. But when you talk about 12, and all of last year there were only 12 over $100 a square foot. I mean, certain hedge funds could afford to pay that. There are different numbers. What about the hospitality? You besides residential, you like hospitality. Have you looked at it?
We recently acquired a hotel at 57th and 6th Avenue, and we looked at that as much buying a location as it was a hotel. And it was a...
Could be a great rental apartment.
It could be a tremendous, it's got a
Condo,
tremendous
rental.
restaurant location. It will be a hotel. We'll run it as a hotel, but the strength of that hotel was driven by the location. And because we have a broad mandate, and all three of us are lucky to have a broad mandate with a long-term perspective, we can take advantage of.
I mean,
some
he
of the
owned a
intrinsic
hotel.
value.
They still own a hotel. We can go to the Hotel Pennsylvania.
We own two. We own one in D.C. too.
Yeah, the hotel.
Actually, Crystal City.
Crystal City is a different. Is a different.
It's a
case.
lovely hotel.
Now, where do you see the opportunities? I mean, where do your clients see the opportunities? Where do you see the opportunities for the balance of 2011?
Our clients see opportunities still, I think, in acquiring debt and converting debt into ownership. We're still seeing a lot of the equity funds entering, as Rob was talking about, entering the property through the debt markets. That seems still to be where, if there are opportunities, that's where they are.
I think that, at Vornado, we see the opportunity through patience, right? I think that there's certainly a euphoric tone to the marketplace, and it's great to see it for our existing portfolio. But as we look to expand the portfolio, I think that we're going to be very, very prudent in looking at these opportunities, whether they come through the debt. I mean, there's still trillions of dollars of debt that need to
Next
come
year
to
in the
fruition,
CMBS
right?
that's coming
Right,
up.
so
right.
there's still problems that have not even come to fruition. So, we're being kind of cautiously optimistic
but
and
isn't
patient.
this partially, none of us, I mean, especially I'm the older one here, I remember when prime was 18%. We're talking about everything is fine today because of the pricing. I mean, the interest rates are so low. You can lock in from the REIT marketplace or otherwise, and you can lock in at 6, 7%, 5% rate. If rates go up, I mean, let's be realistic. There's problems with hyperinflation over here. The economy is not in a great position.
Well, I think you've taken, we're just about to take Rob has young children. My children just got rid of their water wings, but, the water wings are coming off the U.S. economy, and we're going to see if we can swim, right? I mean, QE2 is just about to be finished, and we're going to see how the economy, it's survived with banks having a borrowing rate of 0, and the economy now has to deal with, still have unemployment that is high. We've lost a lot of jobs. Half of those jobs will never return to the U.S. economy. They've been outsourced. Most companies are learning to do more with less. I think that we've got a lot.
But yes,
Lawyers were pessimists.
But there's a point. I mean, you looked at the recent productivity numbers, and they're beginning to top off, and you looked at the economy starting to slow a little bit. I think one of the real positives for real estate is that people are now going to have to start hiring. We've done as good as we can squeezing productivity out of everyone, making us work all day and all night. at that point. And now we're at the point where we're going to have to start hiring, and they're going to have to start.
And you know what?
expanding.
And this has been a topic of discussion over the last year and a half on my show. We have to hire because people have downsized. We talked about it before. People have compressed their offices, taking less space. And until you start hiring, it's not going to. You have to, you have to jolt it. It's like, the patient in cardiac arrhythmia that you have to put the paddles down to get the numbers up.
It's simple economics, though. Now we're at the point where the ratio of gadgets to employees is at the point where add the next employee and he'll add more than his value. And I think we're beginning to find that. And I think that's kind of at the basis of why people are so optimistic about real estate.
But I think part of it, you just restarted the construction on West 55th Street. I mean, Boston Properties doesn't make an error and plan to restart until you have a tenant. You have one signed lease, and it's a great location. You're right near Columbus Circle. It's a good marketplace over there, and you're starting the construction because you think that companies are going to expand.
Well, we certainly have a lot of confidence, particularly in the New York market. And again, New York is different. It really is in almost any other market in the country, with the possible exception of Washington, D.C. I mean, 250 West 55th Street is also a unique transaction in that, we already have a very significant investment there. We started construction back in 2007 and completed construction to grade level. So it's easier for us to start new construction on a 20% pre-leased building than it would be to go out and buy a site and start speculatively, because we're already there and we already have.
Right. You don't have to go out in plans. You don't have to go through this. You're ready. I mean, you can show somebody that in 2 years they can be moving in there.
Absolutely, absolutely, and we'll we will be under construction, active construction this fall. Returning a little bit to your point about interest rates. I mean, interest rates have a lot to do, I think, with what's going on in our business. It's not only our borrowing costs and our cost of equity, but it's alternative investment opportunities for all the money out there, and it's really difficult to say. I mean, one would think that interest rates will go up, and there have been many who have been saying that for a long time.
I wish we could talk more about interest rates and more of this discussion, but 30 minutes have ended, and I'd like to thank Rob Silpe, Jack Connolly, Adam Popper, and Jeff Lenoble. See you next week.
Major support for these programs is provided by Bank of America, Merrill Lynch, and Perfect Building Maintenance, New York Community Bank, All Nation Renovation, Kilroy Architectural Windows, New York's Window Company, Greenberg Traurig, LLP, M&T Bank. Additional support is provided by AVR Realty Company, LLC, Ackman Ziff Real Estate Group, LLC, Bingham McCutcheon, LLP, Briarwood Organization, Capital One Bank, C.B. Richard Ellis, James Orphanides, Centurion Holdings, Cushman & Wakefield, Dimes Savings Bank of Williamsburg, Douglaston Development, DDG Partners, Eastern Consolidated, Hal Fettner, Durst Fettner Residential, Friedman, LLP, Accountants and Advisors, Gemini Real Estate Advisors, LLC, Genova, Burns and Giantomasi, Grubb and Ellis, Investors Savings Bank, Jack Jaffa and Associates Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, Madison Realty Capital, Massey Knackle Realty Services, Meridian Capital Group, Margolin Weiner and Evans, LLP, Certified Public Accountants and Business Advisors, Newmark Knight Frank, RAL Development Services, The Spandrel Group, LLC, Siami Development, SJP Properties, Site Comply, Sterling & Sterling, Stephen Napolitano, The Wickoff Group, Urban American.